Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 182. Man, we got a couple of wild weeks to kind of run through today. We'll look at where the markets are as we start the year here. Last week, there was a lot of data. There was jobs data. There was CPI data. There's Anthropic and AI just taking over the world and sectors selling off. So we need to kind of dial in here, take a step back, look at the market overall, and see how we can improve your portfolio. So, as always, get your mind right and let's get to work.
You dropped this.
Well, as always, welcome back to the show, everybody. So here we are. This is a great weekend to do an episode. So we have Valentine's Day weekend. We got President's Day on Monday. So the stock market is closed. We have just kind of a nice weekend here to kind of regroup with this fast start to the year. So we look at the indexes. The only index that is currently positive is going to be the Dow Jones, up 2.99%. You can think some of the industrials like Caterpillar, some of the safer names, Procter & Gamble, Coca-Cola for that increase there. You look at the S&P 500 actually down now for the year, and the poor Nasdaq almost down about 3% for the year. Actually, the Nasdaq has gone down 5 weeks in a row. And so it would be much worse if we didn't have that big rally 2 Fridays ago where the Dow was up almost 1,200. I believe the Nasdaq was up about 500 or 600. So we gained a lot back, but man, it's just been kind of an interesting couple of weeks. We'll get there here in a little bit when we start talking about Anthropic and AI and how it's impacted all these sectors that it seems to be going after. But you'll notice like this past week, we had a lot of economic data that was really, could have really hurt us, but actually came in good. So when you look at the jobs number that came out for January, the economy added 130,000 jobs, which was definitely more than expected. Most of those jobs were in healthcare and what they classify as social services, which are going to be things like daycare centers and industries or companies like that. And so, healthcare sector, it's not really surprising. We have almost, I think it's 10,000 baby boomers a day retire. And so when you think about those kind of numbers and how many people are retiring and what kind of strain that's going to be on the healthcare system over the next couple of years, you could see why that's going to be one area where there's definitely going to be a lot of jobs needed in that area. And so that data looked good. It's always good to have that jobs created. The unemployment rate actually ticked down to 4.3%, which is very healthy. And then this past Friday, we had CPI data, so Consumer Price Index data, and that came in at 2.4%, which was a good number. I believe the last number, let's see if I wrote down, it was at 2.7. So the fact that inflation is moving down towards that 2% target of the Federal Reserve is a good sign. And so you see these two good numbers, and all of a sudden, the market doesn't really, you would think that it would go up based on that, and it really didn't. So that's kind of interesting because it kind of shows that the market was really expecting there to be all these rate cuts later this year. But when you have 130,000 jobs added, you have inflation coming down, there's really not a reason to cut rates. Now, we did see that the expectation is that we have a new Fed chair and that he'll immediately start to lower rates this summer. I mean, we'll see. The June rate cut hope was basically the market was pricing in a 70% chance that the Fed would cut rates in June. And then it dropped to, when the jobs number came out, it dropped to 50%. And I think it settled the end of the week around 55% is what the expectations are for a June rate cut, which is still, I mean, my goodness, we're 2 weeks into February. It's a short month, but we still have a lot of time until that June rate cut happens. We have a whole nother round of earnings to get to. There's all these kind of things. And so you really see the market right now being really influenced by AI and what the expectations are, and are any of us going to have jobs in the future, and what industries are going to be impacted the most. And so you see this with Anthropic as kind of the catalyst to this. It's not the same as DeepSeek last year, because DeepSeek obviously was a Chinese company, and you saw the impact that had. Anthropic being an American company, and but you still see the impact on the sector. So I actually wrote these down, because they've basically been selling off anytime somebody comes out and says that Anthropic or the coding or the AI is going to be able to take over these industries. So you saw legal companies, tech companies like LegalZoom, or some of the accounting software like Intuit. And then we saw insurance brokers sell off. Then we saw wealth managers sell off. So we saw Charles Schwab and LPL Financial and Raymond James, and it kind of started cascading there. Property managers started selling off. And then the one interesting one was freight and logistics companies, basically saying that we're going to have all these robotic trucks in the future, and maybe we will, but I just don't know if it's going to be as quick as everybody thinks. I'm starting to think, I'm always thinking about Charlie Munger and inversion, right? Like invert. When everybody's thinking one thing, think the opposite thing. And some of these companies that are good companies have good solid customer bases, and they also, not only do they have good customer bases, but they have the data. They have years and years and years worth of data, which is something that makes Google so powerful and so different, right? Is that, when you do a Google search, you're typing your information into Google every single time, and they're able to capture that data, use that data, basically build a profile of you. And so all of these other companies as well, that data is going to be worth something. So it doesn't mean that they're going to go away, but will they be able to use AI to their benefit with that and combine that with the data they already have to make improvements and to make their services better for the customers that they already have. And so I always feel like in these kind of situations, the expectation of something, your greatest hope and then also your greatest fear, neither one of them are probably true. And so I think that we're getting to a point here where, some of these companies, they've traded off so much. They're honestly getting to a point where it's it's so much that it's hard to ignore. When you look at some of the companies like ServiceNow, or you look at some of the other software companies, I don't know. It just gets to the point where you have to start getting very interested in kind of what those valuations look like. Because when you look at the stocks that have done well, it's going to be all the memory companies, and it's all we recorded an episode, I think, a couple months ago called Picks and Shovels, which was just kind of all the hardware stocks that you need. And you do need those companies too. So the memory companies, the storage companies, the memory companies, the power and cooling companies. We've talked about Vertiv, which actually cools down the chips that are in these data centers. They reported a great quarter this past week. And that was one that, I'm just kind of mad at myself for, because I was like, I want to see their numbers. I figured they would have good numbers. I didn't expect the numbers to be that good. There's been so many companies that have reported this quarter that have reported a good quarter and sold off. So I thought I was being smart. I have some clients I want to put into that stock, and I was like, all right, I'm going to wait for them to report, and then if they trade down like everybody else but have a good quarter, then I'll start investing in them at that point. And of course, they're the one company, good report, great sales, they actually go up. And so they went up quite a bit based on those numbers. So Vertiv is definitely on my watch list, if you will, waiting to see if they actually pull back a little bit off of that good quarter, because it was a great quarter. So there are those companies. The hardware companies are definitely good companies, but you got to be careful of changing strategies. And at the end of the day, there's a lot of these companies that are good companies, good cash flow, that I just don't know if the fear, I'm not saying that some of these aren't going to be changed by AI. I'm not saying that their business model might not change. I just don't know if it'll be as devastating as the sell-off has been over the last 5 weeks. So as I said before, Nasdaq's been down 5 weeks in a row. And so you start to look around and go, man, have some of these sold off too much? I think Bitcoin is also part of that problem. I don't spend a lot of time talking about Bitcoin, but I know that there's investors that are out there that are leveraged on Bitcoin. With Bitcoin coming down, they've probably had to sell things they didn't want to have to sell to cover their loss if they're leveraged. And so, at the end of the day, investing, as we've always discussed for the last over 4 years, it comes down to, do you have good companies? Are their balance sheets good? Do they have, are they going to be able to increase their earnings per share? Because at the end of the day, the worst case scenario for me is I just want to have to own it. I don't want to be leveraged on anything. I don't want to be borrowing money. I don't want to be doing these kind of risky trades. And so at the end of the day, it's like, okay, worst case scenario, I got to own this thing for the next year or two. And so for many investors, and of course, many of you who listen to this, we talk all the time about, your time horizon, making sure that you can own this stuff for a couple of years. But I do think that some of these companies that we have seen get massively sold off, there is going to be value there over the next year or so if you can own it. It doesn't mean that they might not go down a little bit, but some of them have been almost cut in half, from the last couple months. So, at the end of the day, you kind of got to go in there, do your research, see what these companies are all about, and see if it makes sense for your portfolio. In times of increased volatility, I will say, one of the things that makes me feel a little bit better, one of the things I concentrate on is when I'm looking at my portfolio, looking to see things. Obviously, the value has come down. It hasn't been a great year so far, but I start paying attention to my share count. I start looking at companies that I really like, that I want to own for the next 3 to 5 years. And I start concentrating on share count. Like, can I get my share count up? Can I go from 50 shares to 60 shares? Can I go from 100 shares to, 110 or 125 or whatever it is? I mean, when I was younger, it was like, can I get to 10 shares? And then it was to 50, and then 100, then 500, then 1,000. I'm always thinking about, obviously, the price of the stock matters, but can I increase the number of shares within my portfolio and just kind of not think about what the overall value is of the portfolio? Now, I know that might seem counterintuitive, but the problem is if you have a portfolio and you see it going down, obviously that's a very emotional thing to most people. Nobody likes to see themselves lose money, even if it's on paper and it's perception. And, obviously you don't lose money until you sell, but it is an emotional thing. And so instead of being anchored to the actual market value of my portfolio, I would rather concentrate on the share count. I would rather look and see, am I making progress in my portfolio by watching that share count go up? And then based on that, I can say, okay, like, I'm doing the right thing. I've increased my shares. I'm investing in companies. The majority of them pay a dividend. So as long as I'm increasing those shares, that dividend is going to buy me more shares in the future. And so it's just a way of making yourself maybe feel a little bit better, like you're making progress, versus when you're in kind of a negative market environment and you're adding to your portfolio on a weekly, bi-weekly, or bi-monthly or monthly basis, and you add money and then the next month you see your account go down. It's not a whole lot of fun. And people definitely do not enjoy that feeling where they feel like they're just throwing money down a wishing well and they don't really see any progress. So little thing that, a little bitty trick that might be helpful, because, at the end of the day, you need a little bit of volatility. You need some stocks to sell off in order to be able to get deals somewhere. And so this is going to be that opportunity. And obviously we don't know how the story ends. We don't know how AI is going to end. We don't know which companies are going to maybe win. We don't know which companies are going to lose. But at the end of the day, if you have a portfolio that is diversified and you have good companies, more often than not, the winners are going to definitely outnumber the losers. And there will be some companies that don't make the switch. And until we know which ones those are, I mean, we kind of got to do the best we can. And so, but you look at that and you have to think, like, I remember when Amazon was starting to come up. And Amazon's coming up in any time, and still to this day for a little bit. Like, if they announce that they're going into a new business, that whatever business they announce they're going into, that sector will sell off. So, for instance, if Amazon, which they did, they started saying we're going to, send out prescriptions, CVS, Walgreens sell off pretty hard based on that knowledge. Amazon was supposed to put out all the booksellers. Barnes and Nobles is still around. I mean, so, at the end of the day, the story, it isn't usually as grave as we potentially think it's going to be. And so you just kind of have to be a little clear-headed and think about, okay, is this giving me an opportunity that maybe other investors are not seeing? And if I'm patient, I can really make this work out for me. Because even, some of the banks sold off based on some of the AI stuff. And AI, maybe years and years from years now is going to take out banks. I don't know. But I would think from my standpoint, I think that banks will be able to use AI. As somebody who worked in a bank for 7 years, I think banks will be able to use AI to their benefit to make themselves more efficient, faster, all of these things, probably prevent errors, then basically replacing them. I just don't see how that's going to be possible for a while, because it's still going to be a person-to-person relationship type business. Why are you going to this bank to make a loan, to get a loan, all those kind of things. So at the end of the day, I do think that this story dominates, and it is easy to go into the Caterpillars and those kind of companies where that they're going to be spending money to use their equipment to build these data centers. But after all of this carnage that has gone through some of these sectors, I think it might be time to just look, not saying big positions here, and you don't have to be bold and you don't have to, catch a falling knife, but it could be an opportunity to kind of go in there, reevaluate, and say, man, what if this story isn't as bad as people think? Is there some value here? Do I think that I'd be able to, buy into a good company that's been beat up quite a bit and that can actually improve my portfolio and improve my performance over the next, 12 to 18 months? So, that being said, take a pause. I do think that we will get a bounce in some of these names. I mean, I'm not saying that's going to happen this week, but I think that over the next couple months for sure, there's going to be some money managers and some investment managers that go in there and they start to buy some of these. There's a metric you can go look up called relative RSI, relative stock index. What is I think I'm flubbing that. Sorry, relative strength index. I did flub it. Relative strength index. So you can go to a website called stockrsi.com. And there's other ones you can use, but that's a good example. And you can type in symbols. So you can type in, whatever it is, AMZN for Amazon. You can look and see if the relative strength index is under 30. That basically means that there has been a lot of selling pressure on on that particular company, and it's probably due for investors to come in and push the stock higher. If the RSI is above 70, that means there's a lot of investors in the name. Probably about time to start taking some profit. I think we've covered this in some other episodes. But if you go look at the stock RSIs of a lot of companies that we've talked about or you've looked at, that we've been discussing, man, a lot of those are seriously low. I think Amazon is probably the lowest I've seen it, or the lowest it's been in over a year. So, go do some homework. Go look at some of the names that are on your watch list. Names that you've been, maybe wanting to invest in, see where they are, see if they've come down. And, again, you don't have to be a hero. You don't have to put a ton of money into these positions, but maybe you start a position. Maybe you add to a position. Maybe you increase the number of shares that you have in those positions. Maybe you trim some from some of your winners that are like the slow conservative stocks, the Coca-Colas, the Procter & Gamble's, those kind of companies, and maybe you move that money, you rotate that money, right? Trading around a position, and you add that to some of the stocks that have been beat up. And that is basically what managing your money, managing your investments is all about. So it doesn't have to be an all or none game. You can do a little bit here and there. So we'll see how the economy looks. There's, everything looks to be pretty good. The early, metrics on tax returns is basically that the average person is getting a 10% raise, basically, or their tax return is 10% greater than it was last year. So that's that amounts to about $300 to $800, which will certainly have an impact on the economy and how those individuals decide to spend it. I'm going to go out on a limb and say they're going to spend it and they're not going to save it. That's usually what happens. So, but from a stock market perspective, the jobs number being good and CPI coming down long term is great for the stock market. It's really hard to have a recession if everybody's employed. And so low unemployment, definitely a good sign for the stock market, even though I thought it would have done better this week because of that. But long term, that is definitely a good sign. So again, we're not thinking 3 to 5 days out, not thinking 3 to 5 weeks out. Think 3 to 5 years. Take a pause, take a breath, go look at some good companies and see who you want to be invested in for the next 3 to 5 years and see if those companies have sold off. Because I think there's going to be some bargains out there. So I hope that's helpful for you. As always, don't mistake activity for achievement, and we will see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.